Good afternoon, Seven investors. Welcome to the Monday edition of Seven Investing Now. My name is Daniel Brooks Kline, but you, of course, can call me Dan. I am being joined today by Steve Symington and Maxx Chatsko. Steve, did it snow this weekend in Montana? How bad is it there?
Everywhere but in Missoula, where I live. I got some pictures from people just a few hours away with a solid foot of snow on their decks, but I've got nothing, just rain.
So, Max, are you jealous a little bit of Steve's potential? Every Monday, it's like, did Steve get eaten by a bear? We have to worry about it a little bit. Is it something you think about, Max?
Yeah, bear watch. We should start that, What day is it now? Like day 742, still no bears? That's pretty disappointing, Steve. Come on.
I haven't gotten good pictures of them for you, but there's been bears. No,
So,
we're more worried about cats.
So, guys, I had an eventful weekend. As you know, on Friday, I got laser eye surgery. And it went well, but as you could tell, still wearing glasses. These are actually reading glasses. What they don't tell you is that you'll be able to drive right away. Like, I could see like an eagle feeding its baby like 300 yards away, but I can't see my computer. So I am working on, getting to the point. It's going to be weeks, maybe months before my vision is fully where it is. So I'm a little disoriented. If I'm not looking in the right place, if I look a little bit odd, that is what's happening today. But we got a busy show planned for you. We're going to start by talking about 5G and sort of how it's investable, where it is now. Then we're going to go into what we're watching. That's where we each bring one following that we're into. Then we're going to talk mostly with Max, but Steve is going to weigh in on sort of chasing COVID-19 as an investor. Sort of, we always get asked these questions. Well, if this company has a vaccine, should I buy it? The answer is generally no, but we're going to let Max talk about that quite a bit more. But guys, the top story, here comes 5G. I pre-ordered my iPhone Pro. I did not get the Max. I decided that my current screen is big enough. I didn't need to go bigger. Maybe it'll have a better battery life. But guys, 5G, are you excited? Is it something you've invested in? Is it an area? Steve, I'll let you go first.
For me, I find myself kind of looking more ancillary plays on 5G. So not necessarily like your 5G pure plays like your Qualcomms or maybe NXP Semiconductor or something, but I find myself looking at the potential effects of maybe a super cycle upgrade cycle that is spurred by this new line, and I think Apple's going to do a great job ushering in 5G and maybe people saying, wait a second, this is a lot faster. I need a new phone. So I'm looking at companies like Universal Display, for their OLED screens, maybe even Corning, which worked on Apple's new ceramic shield. They had Gorilla Glass in the past. So I find myself kind of looking that direction, not necessarily at pure plays or carriers or maybe device makers themselves like Apple personally. That's kind of where I sit.
Steve, I worry a little bit that the iPhone is actually going to have the opposite effect. And what do I mean by that? Is I'm going to get my iPhone, and I don't know if T-Mobile has its sort of muted 5G here in West Palm Beach, but I guess I'm going to find out pretty quickly. And it's not going to be that different because 5G now isn't where 5G is going to be in a few years. So I do worry that people are going to buy and they're going to expect, Netflix to go laser fast, and it's not going to go laser fast. Max, you're the youngest one here, I think. Is this something you're excited about?
Yeah, this isn't something that I cover from, the point of an investor. It's just not my wheelhouse. But, I recently bought a new phone, and sorry, guys, I bought the Pixel. And I bought it before they released their 5G version. And I thought the same thing what you just said, Dan. Like, can I really use 5G? Do I need to spend, $4,000 on this 5G phone right now? So, I think it's going to take longer to kind of gain market traction and be something that's actually useful. But, it's going to replace 4G, obviously.
Yeah. So
if I can interject there, I'd be very, one of the things that I think could be interesting is when people start to get 5G phones and talk about how much faster it is, if it is. So say they're on Verizon's 5G network, they have, an Apple with or a new iPhone with 5G, and they say, holy crap, this is so much faster, than the spotty, weird 4G LTE I had before. That could be one of those things. But if it has the opposite effect, people come in and say, well, it doesn't really matter. Like they've got T-Mobile or something, and the 5G network's like kind of pared down. Maybe they'll be like, nah, I don't really care about this. So that could be really interesting.
I worry about this a lot because true 5G, the blazing fast, 10 times as fast or 5 times as whatever it is what we have now, that's a long way away. We're not going to get that in most markets for 12 to 18 months. So you're going to get your T-Mobile phone, which is what I have. They're leading. They have the best rollout of some form of 5G. And if your current experience is 3G, 4G, and it's kind of laggy, you might experience a noticeable improvement. And if you're buying an iPhone and you were going to upgrade anyway, it becomes a nice add-on. If you went out of your way to buy a higher model of a phone so it would have 5G, I think you're going to be disappointed. So this is something people want, the miracle play. They want like this tiny little antenna company you've never heard of. It's going to be a 10-bagger. Here's the reality. This is going to make Netflix better. This is going to make your phones work better. It is probably going to be good for Apple. It is probably going to be good for T-Mobile, Verizon, AT&T. That said, I'm not so sure how good it's going to be because they're hyper discounting the iPhone 12. They want to move this device. Now, there's a lot of caveats to these discounts. You have to trade in a device. You have to sign a 30-month commitment. So there's caveats there. Now, you can get out of that commitment. It's not like the contract of old. But guys, this is one of those areas, a lot like we're going to talk about the coronavirus stuff, that I say be wary. Steve, you got a last word here.
I feel like at a certain point, iPhone payments are going to be like the new car payment. It's like, well, you got an 84-month 0% interest. It's getting a little crazy. We're sitting out to 30 months to pay for a phone, and what are we going to get by then? This will be
So here's the deal. I have mine financed through T-Mobile. I think it's an 18-month finance, and at 12 months next year, when I trade it in, I might have to pay a little something. I think in this case, mine was actually worth more. So I actually get a little bit of money back. Our boss, Simon, wants to know what implications will 5G have for the Internet of Things? So it's going to make the Internet of Things better. The Internet of Things is this idea that every device is connected. Steve, like maybe your beer fridge will be able to order from Instacart and say, hey, Steve's running low on, a 6-pack of something he drinks every week. Let's place that order. That's a silly example, but the MRI machine at your hospital is going to know, hey, this part's going to go bad in 2 weeks. Let's order that part. Let's make the appointment for the technician to come in and install it. All of that's going to be seamless, and it's going to be everywhere. A lot of stuff in your house, a lot of stuff is going to be powered by 5G, by the Internet of Things, and 5G is going to make that easier. Max, do you have anything automated in your house right now?
No, I'm pretty against all that, all those speakers and things. Someone gifted me one, and I threw it in the garbage. Get that out of here.
Terrible millennial.
So I have an Amazon Echo. I won't say the name of the service in every room in my house pretty much. But honestly, I don't use it to control my lights. I don't use it for some of the things I could. It plays music. It plays podcasts. It's a timer. Guys, let's move on to what we're watching. And Max, this is an interesting one you threw out there. So the Department of Energy has picked 2 advanced nuclear reactors for demonstration projects. You seem excited about this. I don't understand what it means. Tell me what's going on here.
Yeah, this is something I've been following for, it seems like forever, right? So advanced nuclear technology has kind of been in development forever. And now, just recently, I think last week, the Department of Energy picked 2 designs to move to demonstration. So right now, they've all existed in the lab, which is mostly like computer simulations. But this Department of Energy is giving 2 different companies, actually 3, one's a partnership, a bunch of money to build these things within the next 7 years. So that's a pretty ambitious timeline, but the Department of Energy wants to get this technology commercialized, hopefully in the early 2030s. So the 2 companies that are receiving money, one is a partnership between TerraPower and GE Hitachi, which is one of the leading nuclear technology companies globally. They have a design called Natrium. And this is a reactor that's sodium cooled. It's smaller. It's supposed to have a smaller footprint. And it's supposed to use 80% less reinforced concrete than what is typically used in existing designs. So all of that means, so the sodium cooled it can actually, if the temperature heats up beyond the specifications, the sodium will expand and turn off the reactor. So it's a passive safety system. We don't actually need human beings controlling it. So it's
Max, let me jump in here. Do we need nuclear reactors? Are we not moving towards wind and solar and I don't know, happy thoughts as our methods of power? What's the need for new nuclear power plants?
Yeah, so that's the important thing. So these designs here are, they take away a lot of the disadvantages of existing nuclear, right? So you have existing nuclear, we build these big, giant, expensive facilities, and they're always on. They're on for 18 months until they're, taken down for refueling. And when the wind blows in October and then later in the spring, these things are not economical, right? But smaller designs can be built in factories, shipped to site. The facilities are smaller. Natrium specifically can be, have its output tuned. So when the wind's blowing, they can decrease the output, and when the wind's not blowing, they can increase the output. So more economical, and so Natrium wants to build these for less than $1 billion. So this is something that could fit into the market and actually complement wind and solar and other renewables.
So Max, is this safe? So let's say, Microsoft or Tesla or, companies that have the money to do this, that are heavily invested, obviously, in solar and wind and other forms of technology, even if it's just offsets. Is it safe for them to have a nuclear power plant sort of in the backyard running things for them?
we might see some of that. So some of these designs, they're called small modular reactors. So they're actually on par with the footprints of, a wind or a solar facility. It's still, this has not been built yet in the real world, but I think this is going to become a valuable technology, especially as we start to decarbonize our economy. So in the 2030s, nuclear can make a comeback, I think.
Thank you, Max. So guys, before we get to Steve's pick for what he's watching, this broadcast, this episode of 7 Investing Now is, as always, brought to you by 7 Investing. We are 3 of the 7. There are 3 others. That would be Austin Lieberman, Simon Erickson, and Matt Cochran. They're going to rotate in on the show later this week, but we're a membership-based service. You give us $17 a month. We each give you our best stock pick each month, and we give you a lot more than that. Like today, I did a one-on-one call with one of our members. We don't give personal investing advice, but he wanted to know how to use the service better. How many stocks should he own? Can't give specific advice there, can give broad advice. So if you want to come along for the ride, sign up at 7investing.com. If you have questions about 7 Investing, you can email me at dkline, that's DKLINE, at 7investing.com. You want to do a 15-minute one-on-one to learn about the service? Happy to do that. We are a small service. We are connected. We're going to be doing members-only events starting this week where you can talk to us. You can say, hey, Max, this stock you picked, it's doing really well. Is it too late to get in? And you can get those answers, get our perspective on it. We are growing. We are changing. We are very excited to have you along for the ride. Steve, earnings season starts. It feels like earnings season never ends. What are you watching? What are the big ones that you're watching?
I've got a couple hundred stocks we're going to go over here. No, just kidding. Earnings season has begun, and this feels like a more consequential earnings season, I think, than most. Banks already gave us, for the most part, better than feared results last week. Most of them detailed slowing loan losses. They largely described hopeful trends of stabilization in the third quarter. Didn't really seem to matter much as people fret over the uncertainty stemming from the impending election, status of another stimulus deal, so-called third wave of coronavirus cases. Everybody's scared about that. But our investing news feeds are going to get a whole lot more crowded as corporate earnings season ramps, and we're going to see some big moves depending on what companies say in their respective earnings reports. So this week's reports, some notable names that I'll be watching. Netflix tomorrow after the close will be releasing. Last quarter, I think they announced over 10 million new subscribers. I think almost 27 million year to date.
Yeah, Steve, let me jump in here. Is this the quarter? Netflix keeps telling us they've been pulling ahead subscribers. Mm-hmm. Could this be the quarter where it's like they lost 200,000 because they added so many over the past year?
Maybe. I somehow doubt it. Like, part of me wants or maybe hopes that that's the thing. They say they're pulling forward subscribers because of the pandemic, and that's the reason shares fell after last quarter's report. So management suggested growth might slow in the second half of this year compared to 2019. But two things I think that could spur the stock even higher from here. First, if they manage to sustain the pace of growth and prove that outlook was conservative, shares are going to soar. Second, a potential price increase for their core U.S. subscriber base could be coming up. That would be really interesting if they announced that. They actually only recently announced they'll raise prices in Canada earlier this month, which accounts for something like 4% of their user base.
It's like eight people. They actually drove around and told each of them personally.
And they're like, "Yeah, so sorry, we didn't mean to." But last time we saw a price increase in the U.S. was early last year. That's almost 2 years ago. And if Netflix thinks they can raise prices again without really affecting churn, however modest that price increase might be, it could serve to really spur their top and bottom lines and cause that share price to rally.
So, Steve, you're also watching iRobot. That's a company that they make the Roomba. I have a Roomba. It amazes me that this is an investable company because I look at the Roomba, which I own, and I go, who would pay $450 for this, or even $700 if you want a top one? That said, I'm that sucker, and clearly there's a lot of other suckers out there. Your thoughts on iRobot?
They're more expensive. The most expensive Roombas, I think, are like $1,200. They include like a clean base that it empties itself for a couple months at a time. But I'm going to be very curious to see how iRobot held up last quarter, considering and some of their forward-looking comments too. Prime Day is a big windfall for them, as the Roombas usually show up kind of front and center as some of the more attractive deals for consumers. Management said last quarter the pandemic served to really spur demand from consumers who are really beginning to realize the utility of their products. And I'm really curious to see if iRobot unveils any more details about not only their connected user community, which is growing nicely, but also potential recurring revenue streams. So there was talk from management of potential lease options for those more expensive robots that could further spur demand. So this could be a really interesting quarter for iRobot, and especially if the pandemic has continued to really turn people toward their products as viable alternatives to uprights.
So the pandemic has taught us all how dirty our houses are. You spend all day at home. Like we had to buy like a big thing to clean our ceiling fan because we'd never noticed how dirty the ceiling fan had gotten. I actually use my Roomba less because it's noisy. One or both of us is at home at all times working. So previously I used to run out to the gym and I'd run the Roomba for an hour. Now we actually are vacuuming on the weekends rather than, which unfortunately I have 2 cats. A Roomba is very helpful for that. So Steve, another company that people pay way too much heed to their earnings is reporting this week. That's Tesla. People go absolutely nuts for Tesla earnings. What do you expect? I don't put any stock in their numbers, frankly.
Fireworks, I think, is what we can expect. I think the big thing that people are going to be looking at, we've already seen their deliveries numbers for last month. People are going to be looking at whether demand is holding up well. We saw their Battery Day presentation last month, so we have details there. We saw a big order of Tesla semis come in. I think it was something like 140 or 170 Tesla semis that Walmart ordered from Tesla a few weeks ago. But really demand is what people are going to be focusing on. Like, how is that holding up? And is Tesla able to actually take advantage of the manufacturing facilities that they have available with demand that's holding up? So that should be interesting. May or may not cause share price to go bonkers because we all know how Tesla's been the last, year or two.
Steve, let me ask, who are the people that are in a pandemic are buying $50,000 to whatever $1,000 cars? Like, these are really expensive cars. I know we're working, things are good.
Yeah,
I'm not doubling down on a $50,000 car with like the world collapsing around us. Who's buying these cars?
Well, I think that's a matter of the types of people. I mean, that really makes a great point. We're not talking about Ford, where we're looking to move 1 million, units or something in a given month or quarter or whatever. We're talking about a relatively small company that's still early, small as far as operations go, maybe not market cap. It's technically considered the world's most valuable automaker. And, there's talk about them joining the S&P and why they didn't already. And, but if they can achieve sustained profitability, and they're still working off relatively small numbers from that base. So they can find people who are willing to shell out a fair bit of money for a brand new Tesla in this environment. So if we were talking about a company farther along in their evolution and is a much more mature company in that sense, that was more looking to, market to the masses at these stages, it'd be a different story. But there are plenty of people who are willing to spend that money.
That's an important point, and I'll repeat it because you faded out for a bit there, that this isn't Ford. The overall number they need to sell is relatively small, and we have seen during the pandemic, frankly, during the economy of the past 4 years, it's been a rich get richer situation where people who are doing well tend to be doing better. And hey, that includes us, but certainly we'd like to see everyone do well. Steve, I'm going to give you the last word here on earnings, then we're going to seg into my story because they are related. Coca-Cola, what are we watching for with Coca-Cola earnings?
I'm not even sure what I'm watching for Coca-Cola because I don't own it, but I know they report on Thursday, and that's really kind of a pulse of the economy and the American consumer, the global consumer, but yes, America. We like our Coke, and it'll be really interesting to see how people are spending. They give you a good kind of sense for a pulse of the economy and in the state of consumers, whether they're willing to continue spending on this sort of extraneous thing.
Steve, let me jump in. It's really, you're looking at the macroeconomic level of how did their sales break down, and they'll give you some color on this, between the home and restaurants. Previously, their numbers were off, but they sold a lot more to people in their house. Max is, sitting there pounding Diet Cokes or whatever it is because he can't go out to a restaurant. So those numbers were up, but overall their numbers are down. But Coke, and we'll seg into my story, is a company making some changes. Guys, bad news. They are getting rid of some unpopular brands. Some of not unpopular, less popular brands.
How dare you?
They're killing Tab. Steve, do you even know what a Tab is?
I know what Tab is. It makes me think of my childhood, and I didn't even know they still made it or that Coke owned it. So
Tab is the original diet soda. It predates Diet Coke. It tastes like a metal can. I don't know how else to describe it. It is saccharine, and it probably is bad for you, would be my guess. Max, have you ever had a Tab?
Nope.
All right, so here's what's happening here. Coke is getting rid of Tab. They're getting rid of Odwalla. Odwalla they're getting rid of because it requires refrigerated trucks to deliver, and the sales for the brand aren't enough to justify that expense. They're also getting rid of some regional brands that I've never heard of. Zico Coconut Water, Stevia Sweetened Coca-Cola Life, Diet Coke Feisty Cherry. I feel like they made that one up, but I'm going to trust the people at CNBC. And they're going to get rid of something called Northern Neck Ginger Ale and Delaware Punch. Guys, I'm not going to miss any of these, but I like the business decision of getting out of things that aren't working. I'm not precisely sure why in this day and age you wouldn't take something like Tab, which has a diehard following, and make it digital only, where you don't distribute it, you just make it, you overcharge for it. The people who like it probably really like it. They'd probably pay to get it. But that said, if you're Coke, nothing is worth it to you if it's not a multi-billion-dollar brand. So I like this kind of culling of the herd. I like these changes. There's not a ton to say here, but this is a really well-run company. And, could they have sold Tab off? Yeah, sure. Maybe Polar buys it for some tens of millions of dollars. That's not worth it for Coke. You also probably don't want to send customers elsewhere. So does this change your investing thesis for Coke? No, but does it give you more faith in current management that their hands are on the reins, that they're putting their dollars behind the winners? And look, something that's a big hit for a smaller brand would be a giant failure for Coke. So, I'm sure my mom's sad. Anyone who fondly remembers Tab is probably not going to like it. I doubt my mom has had a Tab in 30 years. And I knew it existed because one of our former colleagues is a big Tab fan. So I'm sure people will be stocking up. I will tell you, soda doesn't save that well. It does separate after some point. So it's not like you could buy a rest of your life supply worth of Tab. But Max, you've been quiet for a while. So let's talk about, everyone wants to know, and I think it's a giant investing mistake people are making. Who's going to get the vaccine so I could buy shares of that company? Max, that's fundamentally wrong, right?
Yeah, I've had this question a few times from, people on Twitter, family, friends, and I agree with you. I think it's actually a bad idea to chase the pandemic as an investing, idea, right? So, there's a lot of companies. I mean, I think there's over 100 different treatments and vaccines in development all over the globe. And the reality is, these are going to be not real big money makers in terms of profitability. And we still have no idea which companies are going to be successful, right?
Yeah. And if there is a vaccine, your pressure to sell it at cost or nearly cost is enormous. Nobody wants to be the company who has the cure and is charging tons of money for it. That makes you a terrible, terrible person. And that's not something a big company is going to do. Smaller companies might charge more, but they're going to charge more because their cost structure is higher, not because they're going to make more profit. Max, does this sort of race for a vaccine, though, teach you anything about a company and its ability to sort of develop drugs? Is there any sort of investable knowledge here, if not investments you might make?
Yeah, I mean, it kind of exposes a few of the realities of drug development, which maybe investors don't think about all the time, right? So, trials are one thing, and I think a lot of times investors look towards FDA approval as being the end of the road, and you get FDA approval and then you win. And oftentimes that's not the case. There's a lot of, manufacturing obstacles. Sometimes you have a drug, and even if it's the best drug on the market, it just doesn't gain traction. Doctors don't prescribe it, or it doesn't get picked up by insurance. So that's not something that's going to happen here. But certainly with manufacturing hurdles and the logistic hurdles of just anything that's treating or a vaccine for the coronavirus. This is the first time in human history we needed billions of doses of a vaccine yesterday. So I don't think people are really appreciating. We have to ship these things. We have to keep them very cold. Even in the U.S., there's going to be differences in access between people who live in cities and people who live in rural areas. And then think about, developing countries. So, approval, which is upcoming for multiple vaccine candidates, is not the end of the road. It's probably like the fourth or fifth inning. And it's not an investable opportunity in my mind.
So this is not an area where I invest. But as you know, Max, I've made a pledge that I'm going to buy at least one share of every stock you recommend for the next year. And we can't talk about our recommendations, but let's just be fair to say that broadly, the medical space is one you're in. How do you evaluate a pharmaceutical company, especially when it's a newer stage, maybe doesn't even have an approved drug yet? How do you dig in and look at it as an investor?
Yeah, well, that's actually my upcoming recommendation. November is a development stage drug company and no drugs on the market. So I look at a few different things. I look at, having the science be sound and solid. Sometimes that's harder to tease out for most investors, right? If you don't have a technical background, but you don't want companies taking too big of leaps scientifically with their hypotheses, right? There's been a couple companies chasing, aging cures and things. And if you look into the science, it's kind of weak, maybe stay away from that one until it's a little bit more legitimate. Then you follow clinical trials, right? Obviously you follow those, but there's differences, so when a company's in phase 2 trials, you want to make sure it's, hitting its primary endpoints and it's not close, because once that expands to larger trials with more people, sometimes it can fail then. So you really want it to have solid results all throughout trials. And then again, like we just talked about, FDA approval is not the end of the road. You want to make sure companies are, have their ducks in a row for manufacturing and a good commercial infrastructure for market launch. Especially important in biopharmaceutical companies. I think I talked about this the other day, but the first gene therapies that got approved by the FDA, I mean, their applications were tens of thousands of pages long, but over half of that was just manufacturing data. It wasn't even clinical data from, the safety and efficacy of the drug. So the FDA really wants to make sure that companies are making homogeneous products, especially when it's a gene therapy or a cell therapy where the thing's a living thing. So, different things to look out for investors there.
Yeah, I've joked about this, but it feels like this rushing of vaccines is basically the first step of the zombie apocalypse. Every zombie book you read starts with an uncontrollable super flu, and then somebody miraculously creates a vaccine quickly. And it works great, except when you die, you come back. I don't literally expect that to happen, but there are risks involved with how fast this is going. And, but let's talk a little bit more about a broader sense of investing because of the pandemic. I'll throw out something I've learned that has helped me as an investor during the pandemic, and I'll let you guys each throw out one. We'll start with Steve, but I've learned how companies treat their employees. So in a normal day, like you hear rumors about, Amazon's really hard on its warehouse workers. You don't necessarily see it. We were able to see right up front, okay, what did Starbucks do? Well, they let workers who were at risk stay home and kept paying them for a while. Then they mandated masks of customers and employees and put in tremendous, cleaning procedures in their stores, and in many cases are only operating with outside drop-off and their drive-through. You saw a lot of chains do that. Now, look, some companies couldn't afford to do it, but we saw here, not a public company, Wawa, very quickly put in glass shields and really, put in dividers between the soda machines and things like that. You learned a lot about how companies treat workers, and to me, that's actually a big part of investing. I'll point out, I sold my WWE stock. I used to be a shareholder of WWE in a time where they're not losing a dime because most of their money comes from television. They laid off a whole bunch of people, and some of them were performers who'd been very highly paid, who wanted to leave, and it was just sort of crummy that they picked this time to do it. Some of them were producers and production people who don't have an ability to make a living, and it just made me feel bad about a company whose business I like. Steve, what have you learned that's helped you as an investor during the pandemic?
Well, I'll agree that that pandemic has forced a lot of companies to kind of show their cards, to show their true colors and how they treat people. And that is important. And that's something we write about in our monthly recommendations, and something we have covered with a few companies specifically because it can be such a differentiator. But I would also say that this is it is clarified for me that there are, especially in environments like this, two different distinct types of companies: those that can survive and thrive no matter what, because they are operating independently of the impact of the virus, and those that are enabling positive change. And that's something I've said for a long time, is that I look for innovative companies that can positively change the way we do things and enable that change. So whether that's network infrastructure as we shift to more kind of Internet of Things / higher speed internet, data use, data analytics, artificial intelligence. There's a lot of different trends that are emerging and accelerating from this current situation. So not only companies that can survive and thrive independent of situations like this, but also those that can enable change and benefit from it.
Max, other than how well or poorly every single food delivery service works, what have you learned as an investor during the pandemic here?
Well, Dan, I own a company called WestRock, and it's boring. It's a paper packaging company, right? So they make cardboard boxes and pizza boxes, cereal boxes, everything and anything in between. Now, in recent years, it made a bunch of acquisitions. It's got, a pretty high debt balance, lots of goodwill and intangibles on its balance sheet. And it's a low margin commodity based business and industry. And I completely overlooked that. I thought, who cares? I mean, it's growing. It's got cash flows. The rise of e-commerce, right? People are buying all kinds of things online. We need more cardboard boxes. And there's a lot of plastic-based packaging that's either being outlawed or replaced with paper-based packaging. So I thought, man, look at all these tailwinds. And I had the big, red flag in my head about, man, this balance sheet, maybe that's not so good. And in good times, it did good. And in so-so times, it did good. And then the pandemic hit and the bluff kind of got called. So the company's been shifting around money and share buybacks. Have to actually reduce its dividend and start throwing as much cash as possible at its debt position. So, in retrospect,
is the margin just too low? Like, is it just too easy for somebody else to make a pizza box cheaply as well?
No, there's only a few major players. It's just, it's like 10, 15 years ago, the industry kind of blew up. So there was a lot of consolidation that happened, but there was still a lot of debt that needed to take place to do that. Mm-hmm. So, its main competitor, International Paper, doesn't have as much debt, and but the investors kind of don't care about this industry. So I'm kind of holding on to my shares and hoping that those tailwinds pick back up after the pandemic's over. But
Warren Buffett always said, "You only know who's swimming naked when the tide goes out."
Yeah.
There hasn't been innovation in the pizza box space since that little table that keeps the top up from hitting into it. But Max, let me throw this out there. You probably have never talked to executives there, but they need to make a round absorbent paper towel to sop the grease up. We all use the paper towels when we get the pizza to sop the grease up. They need to make one that comes with it that's extra absorbent. There, I've just innovated the pizza box industry. If you're following along, if you're watching 7 Investing now, you want to follow us on Twitter. That's at 7 Investing. That's the number 7 Investing. And of course, you can find us online. You can subscribe at 7investing.com. beverage.com. We would love to see you there. But guys, I brought up WWE before. It is now time to hit our finisher. Sam, if you want to share the graphic, that would be great. There we go. A 20% drop in a high-flying tech stock's price is time to sell, 4.1%. Nothing to worry about, 29.1%. A yellow flag, 13.5%. And most of you 7 investors got it right. Something you expect. This wasn't a trivia question, but it kind of was. Steve, we don't worry about a 20% drop. We are long-term investors. Give a little color there.
I don't even blink anymore when I see 20% drops. The thing I do is go and make sure that the thesis still holds, because often 20% drops like this are knee-jerk reactions. So when I see surveys like this, I would say something you expect and nothing to worry about. Most of the time, nothing to worry about. 20% drop, especially, I guess perspective is in order. Oftentimes you zoom out and a stock like that's up 300% year to date, and it fell 20% and it's now up, 220% or something.
Right.
It's silly when you look at that kind of perspective. So,
and Max, I'll give you the last word in a second here, but I think something else is I look to make sure like the CEO didn't die or we didn't find out that there was corruption. So like I'll just do like a quick Google search, because if nothing big comes up in this day and age, it's been a lot of like, well, Domino's sales were only up 18%. We thought they were going to be up 19%. And you're like, wait a minute, that news is incredible. And the stock's gone down 20%. When that happens, when it's sort of reacting to analyst expectations, you usually see a recovery pretty quickly. It's kind of a knee-jerk reaction. I don't put a lot of stock in earnings. We're going to talk a lot about earnings over the next few weeks. I put stock in what the earnings tell me. Did this company execute what it said it was going to execute? Was there demand the way they thought there was going to be demand? Hey, they said last quarter was soft because this quarter was off to a strong start. Did that play out true? I don't worry about the numbers. I worry about the story. Max, you can have the last word here.
Yeah, I echo everything you guys just said. And analyst expectations, it's a bunch of models in a spreadsheet, right? It's kind of funny how much power that has over some of these stocks sometimes. And oftentimes it is a short-term concern. So if you feel very good about a company, and like you said, it's, they missed by, $1 million or something, like, who cares? And maybe that's the time you add to your position.
It is not easy to be a long-term investor, but it's an advantage. That's our show. Thank you for watching. Thank you for putting up with the fact that I can't see particularly well. I can read. I'm wearing these terrible glasses. If I take them off, I realize how incredibly red I am. But you can follow us at 7investing.com or, of course, at 7investing on Twitter. Max, Steve, I'll see you guys later.
All right.